Imagine finding out that an incredible 27% of a massive regional bank's customers just voluntarily leave their money in accounts that earn absolutely zero interest.
Which is wild to think about.
Right. I mean, in a financial world where you can open a phone app and practically beg a high yield savings account to pay you 4 or 5% for your cash, why would billions of dollars just sit there earning nothing?
It is deeply counterintuitive. In modern finance, we kind of always assume everyone is a perfectly rational actor chasing maximum yield. But the data often tells a completely different story about actual human behavior.
Yeah, totally. Well, welcome to today's deep dive. We are looking at a very specific, data-rich stack of sources today to solve this mystery for you and really figure out how a bank actually thrives when the broader economic forecast is telling everyone to proceed with caution. We've got the Q1 2026 earnings presentation and press release from United Community Banks, Inc., or UCBI, which is a $28.2 billion Southeast regional bank. And interestingly, our sources also include a couple of raw security verification logs from MarketBeat.
Which I know might seem like a total mistake at first glance.
Mm.
I mean, those are just the automated anti-bot screens you see when you try to access financial data online.
Yeah, the ones where it makes you click the bicycles.
Exactly. You get a Cloudflare Ray ID, the system checks your browser, and it basically verifies if you are a human or, a malicious script trying to scrape data.
But it actually provides the perfect lens for today's discussion. That digital verification screen is essentially a bouncer. It is vetting risks.
Spot on.
It's analyzing credentials before granting access. And when you look at how UCBI is navigating the 2026 economy, their entire operational playbook is basically doing that exact same verification process, but for billions of dollars of capital.
It really is.
So, our mission today is to decode how they are vetting that risk and how it translates into a massive 19% year-over-year earnings growth. Okay, let's unpack this. How do we even explain that 0% interest phenomenon?
Well, to understand that, we have to look at the very foundation of UCBI's business model. They are managing $24 billion in customer deposits right now.
Wow, 24 billion.
Yeah, and that's spread across roughly 200 branches in 6 Southeast states. So that 27% figure you mentioned earlier, that represents their non-interest-bearing demand deposit accounts.
Okay, so checking accounts, basically.
Exactly. And the reason billions of dollars stay in those accounts isn't because the customers are just ignorant. It's actually because the incredible stickiness of relationship banking.
Meaning what, exactly? Because, I think a lot of people view switching banks as a major hassle, but that alone doesn't explain leaving that much money on the table.
Right, it goes way deeper than just the hassle of, switching your direct deposits over. The earnings presentation highlights that UCBI was just named the most awarded bank in the Southeast region for retail banking customer satisfaction by J.D. Power.
Oh, wow. J.D. Power is a big deal.
It is. And that isn't just a one-off thing. They've actually won it 12 of the last 17 years.
That's pretty wild consistency.
Yeah. And alongside that, they've been an American Banker Best Bank to Work for 9 consecutive years.
Wait, okay, I get how customer satisfaction keeps people around, but what does an employee award, like the best bank to work for, have to do with getting those cheap deposits?
It's basically the mechanical engine behind the trust. High employee retention means when a local business owner walks into a branch to, say, manage their payroll, or a family comes in to discuss a mortgage, they are talking to the exact same loan officer they talked to 5 years ago.
Oh, I see.
Yeah, that institutional memory creates a very specific, deep kind of trust. A mid-sized business using the bank's treasury management services isn't going to pull their operating cash to chase a few basis points on some fintech app if they rely on their local banker to immediately resolve a payroll glitch on a Friday afternoon.
Because the app doesn't have a guy named Bob you can call at 4 p.m. on a Friday.
Exactly. That relationship secures the deposits. And securing cheap deposits is really the lifeblood of a bank's profitability.
Okay, so they have a massive pile of cheap, sticky deposits. But just holding cash doesn't automatically generate 19% earnings per share growth. Let's look at the actual operations here.
Let's do it.
The headline numbers for the first quarter of 2026 show operating earnings per share hitting 70 cents and total revenue reaching $276.5 million. So what does this all mean? If they aren't paying much for deposits, what are they doing with that money to generate that kind of revenue jump?
What's fascinating here is that they are actively managing a metric called the net interest margin, or NM. This is the absolute core of traditional banking.
Right, in him.
For UCBI, their net interest margin actually expanded to 3.65% in the first quarter. That is an increase of 29 basis points from just a year ago.
I want to make sure we are crystal clear on INM for you listening because it's a term thrown around on financial news channels constantly. Think of a bank's operations kind of like a municipal water system.
That's a good way to look at it.
The bank buys water from the reservoir, which is the depositors, at a wholesale rate. Then they pipe it through their infrastructure and sell it to neighborhoods, the borrowers, at a retail rate. The net interest margin is essentially the measure of how much water they actually get paid for versus what they had to spend to acquire it.
Exactly. It's the spread.
But expanding that margin by 29 basis points on a $28 billion balance sheet is a huge move. How did the management team actually widen the pipes?
Well, the sources detail a very deliberate strategy that the CEO, Lynn Harton, calls a shift in the earning asset mix. In banking, your assets are the loans you make and the securities you invest in.
Okay.
UCBI had these older, lower-yielding investment securities sitting on their books. And rather than selling them and taking a really complex accounting loss, they simply allowed them to mature.
Oh, smart. Just wait it out.
Yeah, they took that harvested cash, combined it with $237 million in brand new customer deposits they gathered during the quarter, and just rotated it into much higher yielding vehicles.
And the presentation breaks down exactly where that money went, right?
It does.
They funded $218 million in new loan growth, and they specifically saw really high annualized growth rates in commercial and industrial loans, around 10%, and home equity lines of credit, or ELA-LOCs, at 8%.
Right. They methodically swapped out low-paying financial instruments for high-paying loans.
Look, I have to push back here for a second. Taking hundreds of millions of dollars in cash and pumping it into commercial loans and ELA-LOCs right now seems inherently risky, doesn't it?
How so?
We've seen all these headlines about commercial defaults rising nationally following the rate hikes over the last few years. How is expanding into commercial lending a smart move when the broader economy is still sending really mixed signals? Are they just chasing high yields to juice the quarterly numbers?
That is a very fair critique. And it's exactly why understanding the mechanics of these specific loans is so crucial. Commercial and industrial loans, or C&I loans, as well as HELCs, are typically variable rate products.
Ah, variable rate. Okay.
Yeah. By heavily leaning into these specific categories, the bank is actively positioning its balance sheet to capture more revenue if interest rates stay higher for longer. They are effectively passing the cost of capital right on to the borrower.
So they are letting the borrower absorb the interest rate risk.
Precisely. And they're coupling that with really aggressive management on the other side of the ledger. The data shows that their older time deposits, like CDs, matured and ran off the books at an interest rate of 3.36%.
Okay, I'm tracking.
But the new volume of time deposits they brought in came on at 3.06%.
Wait, I'm looking at those deposit numbers and I'm a bit confused. If old deposits are leaving, the bank has to attract new money to replace it, right? Doesn't that usually force a bank to offer higher promotional rates to get people in the door, which would end up costing them more money?
Usually, yes. When a bank is desperate for liquidity, you'll see them offering massive CD rates to attract capital. The fact that UCBI replaced 3.36% money with 3.06% money tells us their liquidity position is incredibly strong.
Oh, because they didn't have to bribe people to stay.
Exactly. They didn't have to overpay to attract capital. Every basis point they shave off their deposit costs, while simultaneously increasing the yield on their loans, acts as this sort of dual engine driving that net interest margin wider.
Okay, that makes sense. They are expanding the spread from both directions, but relying solely on the spread between deposits and loans seems vulnerable. I mean, if we stick with the water system analogy, if the reservoir dries up, or if the neighborhoods suddenly stop buying water because the retail price is too high, the whole system breaks down.
Right, which happens in recessions.
Exactly. So how does a bank of this size insulate itself against a sudden shift in interest rates?
Well, they build counter-cyclical shock absorbers. In banking, this is called non-interest income, which is essentially just fee-based revenue. It doesn't rely on the spread between borrowing and lending at all.
Like service fees and that kind of thing.
Yeah, and UCBI has actually developed several of these alternative revenue streams. For instance, their mortgage division saw lock volume, which is a leading indicator of future mortgage closings, jump 24% compared to the first quarter of 2025.
The sources also highlight a division called Navitas. What is that, and how does it fit into this whole strategy?
So Navitas is a technology-enabled, small-ticket commercial equipment financing provider.
That's a mouthful.
It really is. Basically, if a local dental practice needs to finance a new imaging machine or a restaurant needs a commercial oven, Navitas facilitates that. It's a very specialized, high-velocity type of lending that generates strong fee income.
Like a Swiss Army knife of banking.
Exactly. Along with their National Small Business Administration lending franchise, these divisions provide a really steady flow of revenue that helps stabilize the bank, even if traditional loan demand fluctuates.
Now, when we look at the actual non-interest income data in this earnings presentation, there is quite a bit of accounting noise. I want to make sure you, the listener, understand how to read between the lines of a dense earnings report here, because companies often use adjusted numbers that can obscure reality.
Absolutely.
So there are two specific one-time items that impacted the GAAP or generally accepted accounting principles numbers for this quarter. First, they reported a $5.2 million gain on terminating something called a subordinated debt cap. What exactly is a subordinated debt cap, and how does terminating it instantly generate $5 million?
That was a great question because subordinated debt cap sounds like impenetrable financial jargon. Let's break down the actual mechanism.
Please do.
A debt cap is essentially an insurance policy the bank purchased in the past to protect themselves in case interest rates skyrocketed. They paid a premium for a derivative contract that would pay them out if rates went above a certain threshold. It was just a hedge to protect their balance sheet.
Okay, so they essentially bought disaster insurance.
Exactly. But as the economic environment evolved into 2026, the risk of a massive sudden rate spike diminished. The bank's management realized they no longer really needed that specific insurance policy.
Right.
Because that derivative contract still had value in the open market, they just sold it. They closed out the hedge, and the proceeds from that sale resulted in a $5.2 million one-time profit on their books.
So it's a structural adjustment, not recurring revenue. It's kind of like if I sell my car, I have a bunch of cash this month, but it doesn't mean my actual salary went up.
Spot on. You really have to subtract that gain to understand the true ongoing operational health of the bank.
Got it. And there is a second major accounting adjustment, this time on the expense side. They took a one-time $6.7 million hit labeled as a payroll transition bonus.
Yes, the payroll shift.
At first glance, taking a nearly $7 million charge just to change how you do payroll sounds like an administrative disaster. What is the actual mechanism at play here?
It's actually a fascinating look at corporate operations. The bank decided to change its overall payroll cycle. They moved from their previous system to paying employees bi-weekly in arrears.
In arrears meaning you work for 2 weeks, and then you get paid for those 2 weeks a few days later, rather than being paid current to the day.
Right. It's a very standard corporate payroll structure.
Yeah.
But the transition itself creates a mathematical gap.
How so?
Well, if you tell thousands of employees that their paychecks are suddenly going to be delayed by a week or two as the new calendar syncs up, you create massive personal cash flow problems for your staff. Mortgages and car payments don't care about a corporate accounting transition.
Ah, I see. So the $6.7 million wasn't just administrative waste.
No, it was a bridge. To ensure their employees didn't suffer a gap in their personal cash flow during this shift, the bank just paid out a one-time bonus. They willingly absorbed a multi-million-dollar hit to their quarterly expenses to protect their staff.
That ties directly back to that best bank to work for culture we discussed earlier.
Exactly. It's an upfront cost that secures long-term loyalty.
Okay, so if we strip out the $5.2 million windfall from the debt cap insurance, and we add back the $6.7 million payroll transition cost, the core operating engine is still incredibly robust.
Highly robust.
But here's where it gets really interesting. I want to go back to the pushback I raised earlier about commercial risk. We are talking about aggressive loan growth, maximizing yield, and passing rate risks directly to borrowers. In an uncertain 2026 economy, what happens if UCBI miscalculated?
The worst-case scenario.
Right. If they are vetting risk, like those market beat security screens, what happens when a bad actor, or in this case, a bad loan, slips through the firewall?
That is the existential question for any bank, and this raises an important question about their defense strategy. You can measure a bank's defensive posture by looking at their allowance for credit losses. UCBI currently holds a staggering $208.4 million in reserve.
$208 million just sitting there to cover loans that blow up. Is holding that much cash in reserve a sign of strength? Or is it a red flag that they are quietly terrified of their own loan book?
Well, to determine that, we have to look at their actual credit quality, like what is actually defaulting today. Their net charge-offs, which is the hard cash they had to write off as a loss because a borrower simply couldn't pay, was a minuscule 0.22% of their average loans.
Translate that math for a second. For every $10,000 they lend out to borrowers, they are currently losing about $22.
Exactly. It is incredibly pristine credit quality. So when you measure that tiny loss rate against their $208 million reserve, they have a 1.15% coverage ratio of their total loans.
That's huge.
Mechanically, they are holding over 5 times more in reserve than they are actively losing.
That is a massive safety net.
What's even more telling is a tiny detail in the press release regarding that allowance. The 1.15% coverage ratio is actually down slightly from the fourth quarter of 2025.
Why would they lower it?
The earnings release explicitly notes the reason for this. There is, quote, more optimism in the economic forecast, unquote. The bank's internal models are actually showing a stabilizing economy, meaning mathematically, they just don't need to hoard quite as much cash for doomsday scenarios.
Yeah, and if the defense is that impenetrable, it completely changes what the bank can do strategically. They don't have to cower in a defensive posture at all.
Right. We measure that overall defensive strength using a metric called the Common Equity Tier 1 ratio, or CET1. Regulators use this to test how resilient a bank is to financial stress.
Like a stress test grade.
Yeah. It compares a bank's core equity capital, its absolute safest, most liquid assets, against its risk-weighted assets. UCBI boasts a CET1 ratio of 13.4%. That is well above their peer median. It is literally a fortress-like capital position.
And when you have that much excess capital safely secured, you have the luxury of returning cash to the people who own the company. The sources show they executed on this aggressively. They went into the open market and repurchased 1.09 million shares of their own common stock for roughly $37 million. That's at an average price of $33.97 per share.
Stock buybacks are a really fascinating mechanic. By buying and retiring those million shares, the total number of outstanding shares shrinks.
Right.
That means every remaining share held by investors instantly represents a slightly larger percentage of the company's total profits. It's a massive signal of confidence. Management is essentially declaring, we've looked at the landscape, and buying our own company stock is the safest, highest-yielding investment we can possibly make.
And on top of shrinking the share count, they declared a 25-cent quarterly dividend, which is actually up 4% from the prior year. So if you are a shareholder, your slice of the pie is getting mathematically bigger, and the cash being handed out from that slice is increasing.
It's a dual-engine capital return program.
And it's made possible entirely by how strictly they vet their risks.
If we connect this to the bigger picture, it perfectly positions them for the final, most aggressive piece of their strategy, acquisition. Because their foundation is so solid, they aren't just defending their territory, they are expanding it.
Oh, yes. The merger.
Exactly. This financial footing leads directly to the announcement hidden toward the end of the press release. UCBI has executed a definitive merger agreement to acquire Peach State Bancshares, Inc.
So they're taking all these optimized systems we just talked about, the cheap deposits, the strict loan vetting, the high margin fee services, and they are about to just bolt an entirely new bank onto the side of it, applying their operational playbook to a completely new set of assets.
Exactly. Mergers often fail when a weak bank tries to buy growth just to hide its own flaws. But when a bank with a 13.4% CET1 ratio and a deeply loyal customer base acquires a competitor, they're operating from a position of massive leverage.
Because they already have the right systems in place.
Right. They can absorb Peach State, strip out the operational redundancies, and immediately apply that 3.65% net interest margin efficiency to the newly acquired deposits.
Wow. It really has been a journey from those initial market beat verification screens to unpacking the complex mechanics of a $28 billion financial engine.
It sure has.
We started by looking at a simple digital bouncer, a perimeter check verifying credentials to keep bad actors out, and we ended up exploring how a bank does the exact same thing on a macroeconomic scale. What UCBI is doing isn't some secretive Wall Street magic. It is meticulous, disciplined execution.
Very disciplined.
They are actively shifting their asset mix, letting low-yielding investments expire and rotating into higher-yield loans while making the borrower absorb the rate risk. They are aggressively managing their deposit costs because of deep customer loyalty. They have built counter-cyclical fee businesses like Navitas to act as shock absorbers, and they're maintaining a massive $200 million cash reserve just in case their models are wrong.
It covers all the bases.
There is a deeply practical lesson here for you, whether you are analyzing a regional bank stock, managing a small business, or just trying to optimize your own household budget. You have to vet your risks, clean out the low-yielding assets in your life, control your borrowing costs, and, never ever forget to build your emergency reserves.
It really is a masterclass in balance sheet management. But, as we step back, I keep returning to that single provocative data point we discussed right at the start.
Oh, the 27%.
Yeah. 27% of their deposits earning 0% interest. We've spent this entire deep dive breaking down complex mechanics, subordinated debt caps, CET1 ratios, earning asset mixes. It is all highly technical, highly quantitative analysis.
The hard math of banking.
Yes, the hard math. But that math only actually works because of a deeply unquantifiable human element. Business owners and families are willfully ignoring algorithmic yield chasing because they value the relationship with their local banker. They value trust over a few extra basis points.
Which creates a really fascinating tension for you to chew on as we wrap up today. We are accelerating into a highly digitized, artificial intelligence-driven future. We are surrounded by frictionless apps, instant money transfers, and algorithms that are fighting a constant war for every 0.1% of yield on our capital.
Absolutely.
Everything is designed to completely remove the human from the equation. But if you look at the underlying success of a massive institution like UCBI, it begs the question. In the financial wars of the future, will cutting-edge tech and raw interest rates ultimately win control of our money?
Or is the simple, undeniable human power of exceptional customer service, a friendly face, a trusted advisor, a genuine relationship, the ultimate, unbeatable competitive advantage?
It makes you wonder. The next time you are staring at one of those digital security screens, waiting for the system to verify that you are, in fact, human, well, maybe it's that very humanity that matters most of all.